Hey everybody, I hope you and your loved ones are safe, happy, and healthy. Before you listen to or watch the show, remember to subscribe and follow the Mortgage Broker Club on Facebook and LinkedIn to stay up to date with all the latest news and updates. Please note we are not a mortgage broker and do not lend money directly to clients. Remember, a mortgage and/or borrowing secured against your home or property can be repossessed if you do not keep up the mortgage repayments. The content of this show is for information purposes only and is not to be relied upon. Stay well, and I hope you enjoy the show. Welcome to the show. I am your host, Sean Rogers, and I am delighted to be joined by Peter Turner from Glenhawk. Glenhawk provides short-term property finance with a strong capital base to lend, whether you are looking to acquire a new property, unlock equity in a current property, or you're initiating a property investment or refurbishment. On today's show, we're going to be discussing the latest market trends, how best to handle problem cases, and the solutions available. And I'm going to be asking Peter for his views on the bridging market as a whole. Firstly, Peter, how are you and how are things?
Sean, very well, thank you. Yeah, sun's out. It's a Friday, so it's happy days.
I know we are recording this on a Friday afternoon, possibly the last sun of the year. So, to have Peter in an office doing the show, we're very humbled and happy to have you. Peter, you have 20 years experience plus within the financial services sector. Can you tell us about your experiences prior to joining Glenhawk, and what is it about Glenhawk that led you wanting to join them?
Yeah, of course. It's a few more years than 20, to be honest. But I started with Barclays, stint at RBS. I then joined a brokerage. Fancied a bit of a change. That was a couple of months before the crash, so that was great timing to become a broker. Stuck that out for about 4 years, and then I joined Shawbrook. I was introducing business to them as a broker. They just started looking to expand their sales team, and it just seemed a great place to go. So I'd 7.5 years at Shawbrook as a BDM, covering kind of London and the southeast, which was great. And then out of the blue, got a phone call from Guy. They just set up. They were looking for someone established and the BDM side. So I had a conversation with them, with Guy and Nick, and just really liked what they were saying, where the company was, what their visions were, how they thought that I could get involved and help with that. And it just seemed a great opportunity. And been here just over 2 years now. We've got more staff in, but it's very much family. They listen. If there's issues, if there's suggestions, it's all taken on board. Some are action, some aren't. But that's kind of nature of the beast. But it's just great to be part of it. Everyone wants to get deals in, get deals done, get them out the door, and then get them repaid as well, which is some of the fun. But no, it's just a great place, and it's a buoyant market. So it's when you've got people that want to do deals, then I think that's a massive plus.
What has been the biggest change you've seen in the bridging and mortgage sector over the past few years?
I think the biggest thing is it's become mainstream, which is great. Back in the day, it was very much, I wouldn't say, last resort. It was used by people with generally bad credit because they couldn't get finance elsewhere. But now it's mainstream. It's it's something that certainly property professionals, which we see, it's a way of them making money, adding value to property. It's quick. It could be a bit quicker, with all the various challenges with the process, but it is still quick money, and if you pick the right lender, which I think Glenhawk is one of those. We look after the client and make sure that the journey is as smooth as possible for it. So I think that's the main thing is mainstream. There's a lot more awareness about it, and it's competitive. Number of lenders out there, the pricing is down, it's getting cheaper. But as we know, that's not always the ultimate driver. It's guarantee of money. So yeah, mainstream and competitiveness.
And bridging loan applications for the year to the end of June 2021 were 26.9% higher than applications in the year to the end of June 2020. And there's also been a reduction in the number of loans and default and number of repossessions. So two aspects to this next question. Firstly, why do you think the bridging market is achieving those kind of figures? And secondly, what's your take on the current state of the bridging market?
Okay, I mean, I think I kind of touched on it before that it's mainstream, it's awareness. There's now a lot more brokers that are aware of what a bridging loan is and how it can be used, and how it can be used as a solution for their clients. I think the quality is better. It's more property professionals that are using it, and also, I think the regulated side has probably seen a bit of a jump on that, which is something Glenhawk entered last October. So that's a big market with chain breaks. Especially at the moment with prices being competitive. The chains do break down, unfortunately. But also, people want to add value to their main residences or what they're buying. And sometimes a bridge is the right way to do that rather than going straight into a mortgage. So yeah, I think just awareness, and also the fact pricing, I think, comes in probably the same answer for both questions, Sean, in that it is more readily available, it is cheaper, so it's a bit more attractive for people.
And great place to get stuck into some real life examples and issues clients face and what solutions may be available out there. So for instance, we saw a case recently where a client had developed residential units and was running out of time to sell them, with the existing development finance partner who wouldn't extend or increase the loan. So if someone was in that situation, what are their options? What are the sort of underwriting considerations, and what exits are well considered and also acceptable? Yeah,
I mean, we see a lot of them. The people call them developer exits. Some people call them marketing loans. It's basically, as you say, it gives someone the time to sell their properties at market value rather than having to drop prices, discount, reduce the value of them. It gives them the time to sell or to refinance. So we had one a couple of weeks ago that was a customer had built 3 new houses, and had also converted an existing house into some flats. They sold one of the houses, they'd refinanced the flats onto buy-to-lets, and they had 2 other houses left. They had another project with the same development lender, but the development lender wanted the money back before they would lend them for the next project. So we came in at 75% of the open market value, which is what we lend on residential, which gave them a bit more cash, and it also gave them another 12 months to sell the properties. I think one of them will probably be redeemed very quickly. So I think they've exchanged, but it just worked out perfectly. I would say from an underwriting point of view, we look at where the development is. Look at, obviously we pay great attention to the valuation. So what's the demand like for sale? How long is it going to take? Is the sale price realistic? If they've been on the market, then why haven't they sold? So are they priced too high? Do we need to get that down? So those will be discussions we'll have with them. But a lot of it will come down to the client's kind of net wealth, asset and liability position, and the valuation. Is it realistic that they, whatever term they're after, sometimes people will ask for a 3-month term, and realistically, the sale isn't going to happen. So you have to stretch it a little bit more. But with something like that, we have the ability to either retain the interest, or the client can service it. So there's ways of making the loan size work. But you find quite a few developer exits are lower loan to value. People aren't always looking to take all their profit out. So I've seen a few 50%ers, even less than that. It just redeem what they've got already, so they can move on to the next one.
And turning to HMOs, many believe HMOs will continue to grow in popularity over the coming years. We've seen many cases where clients are looking to purchase a property, refurbish it, and then sell it as a HMO, not necessarily keep it to rent out the units, for want of a better phrase. Before proceeding, what should the client consider initially? You know, it could be PD rights, schedule of works, things like that. What are the underwriting considerations and solutions in a situation like that where, you know, you're looking to purchase a property, refurbish it, and then sell it as a HMO? And what are the exits considered acceptable? Like, is selling it as a HMO acceptable to you?
Yeah. Okay. I would say there's quite a few things that a customer would need to consider when they're looking to do a resi to HMO. You know, is planning required? Can they do it under permitted developments? If so, great. You know, is it in an Article 4 location where there's a restriction by the local council in that you can't change a residential to an HMO under permitted development? Schedule of works is important on any refurbishment or conversion project. Is it realistic? You know, there's lots of talk about, you know, cost of materials have gone up over the last 18 months with COVID. So, you know, that's something, again, we would ask a valuer to review. And depending on the level of work, we may want an asset manager or a quantity surveyor to review that and monitor the project. I think licensing, you know, the rules have changed over the last 12 months. You know, minimum room size, how much space there needs to be, communal areas. So, you know, there's a lot for a first-time person to look at and consider. And I think for us, you know, the broker is important in that journey as well, because they will help the client and make sure that they've got the right team behind them or involvement in the project. Underwriting considerations is, you know, have they completed some refurbs or conversions before? If they haven't, it's not the end of the world, but, you know, we would want to understand who's going to do the work, who's going to monitor it, to make sure that it can come within timescales and within budgets as much as you can. I think the exit is really important. Yes, sale is acceptable. Refinance, we probably see more as an exit, because most people will convert a house to an HMO for rental yield rather than for capital value. Now, what the underwriters and the client and broker would need to understand is the exit. You know, is a lender, they switch it to a buy to let, are they going to do it on an investment value, so a rental yield, or is it going to be on bricks and mortar? And that can come down a lot of the time to, is planning needed? If it is, let's say, to change from a 4-bed house to a 7-bed HMO, you've got planning, there's value within that planning, and therefore the rental is probably more achievable than investment value. You know, if you've got someone that's bought a 3-bedroom house and converts it into a 5-bed HMO because they've used the, you know, reception room or a front room and made it into a bathroom, into a bedroom, you know, shared facilities, you know, is someone going to pay an enhanced value for that? Probably not, because they could probably buy it as a 3-bedroom house down the road and do the work themselves. So, you know, those are the sort of things that I think most brokers would discuss with the client. And certainly from discussions I would have on inquiries, those are sort of things that we would want to bottom out early to see whether it's something we can assist with.
And turning to second charge bridging loans, sometimes they can appear quite complex. Often we've been reading they can be used against the main residence, but for commercial purposes. So as an example, you might be buying a commercial building, converting it into apartments to sell, etc. Is this something that you're seeing a lot of? And also, can you go through an example in practice of that?
Yeah, of course. Yeah. We see a good amount of second charges. Now, for us, we can do a second charge on the client's main residence or on any residential property. So we probably see more second charge on main residences, as you say, for commercial or business purposes. We'll make it unregulated from FCA point of view. Now, the business purpose, it could be to actually physically invest into a business. It could be that the clients are property investors, therefore that is their business, so they're using that second charge to go towards maybe buying or refurbishing other assets. The couple of examples we've seen recently is where we had a client. Actually, it was on in new build properties, and it was one that I was kind of being a bit cheeky and asking if we could help with. But Nick and Jamie, Nick our MD and Jamie sales director, it was like, okay, never been asked that before, but actually, why not? It was a client that needed to repay development finance. And it was they were arranging a C-bills loan, but there was a limit on the amount of the C-bills loan, so it left them about £600,000 short. So we actually did a second charge. It was secured across 3 assets, 3 houses, and the original C-bills loan was virtually repaid from the sale of the first. So we were then left with a very small second charge on 2 nice assets. So that worked really well, but say it was a scenario I wasn't sure we could do. The other ones we can look at is more where someone doesn't want to put cash in towards a project, so they would rather use an asset. And again, these are kind of property professionals. Cash is king in every walk of life. So people will give us a second charge on their main residence or on other buy-to-lets, which means we can fund 100% of the purchase price and potentially the refurb costs as well. So apart from a bit of stamp duty and other associated costs, they're not actually spending hard cash on it, because I'm sure you're aware, investors are looking for deals and projects all the time. So if they can keep a bit of cash that they can put down on something to hold it, then they would rather do that than having to arrange the finance. Second charges is a good market for us, and we can go up to 70% of open market value.
Peter, in respect of commercial premises, following on from that, say I was looking to purchase a commercial property, I already have the tenants lined up, they're in place, and my plan is I want to refinance with a term lender, say in a year's time, 12 months. Is that doable? And what happens if I lose those anticipated tenants? So for whatever reason, they just can't come in?
Yeah. So we look at a lot of commercial property and semi-commercial as well. So again, we can go up to 70%. We're happy with it being vacant or with it being let or about to be let. So it doesn't make a difference to us from a lending point of view. We again would look at the valuation. So what's the valuer telling us the demand is like to let that property? So if they say you should let it within 3 to 6 months, your tenant pulls out, we've got a 12-month term, then we're pretty confident that you'll find someone. And again, we would look at your experience as a client. Do you have other commercial property? What other tenants do you have? What other assets have you got in the background? That sort of thing. I think what we've seen, or I've seen the last few weeks, is a couple of commercials where we're actually lending off, again, the investment value. So like on the HMO we talked about earlier, one of them had a Boots as the tenant, big commercial, had 8 years left on the lease. So we were happy to lend off the investment value rather than the vacant possession value. And in that instance, it was about a £300,000 difference. So it was, the client loved that they were putting less cash in towards it. There's others where you might have a tenant or a lease that's expired or is about to expire. So, the bridge will allow you time to renegotiate that lease or get a new tenant in place. We're seeing a few where with the permitted development changes, where people are looking to maybe convert offices or storerooms upstairs into residential. So again, they need to renegotiate on the lease. The bridge will give them time to do that. And if they need to get planning, it gives them time to get planning, which they can then come back to us potentially, and we could raise the finance against the enhanced value with planning, and also lend them the conversion costs up to about 65% of the end value GDV. So I think commercial is becoming more and more prevalent, and I think portfolio landlords are looking at other ways of diversifying from standard residential, whether that is HMO, whether that is commercial, and everyone is looking to add value to a property. There's very few people that want to buy something that's finished and complete unless you're going to live in it. But if you want it for an investment, if you could go in and spend some money and add value to it, get your rental, it's happy days for everyone.
And finally, if a property developer or mortgage broker wants to get in touch or learn more about your products and services, Peter, how would they go about that with you?
Best thing is to give me a call, drop me an email. So my email is pt, nice and easy, pt@glenhawk.com. There is a generic lending team at glenhawk.com as well, which will hit the sales desk and also all the BDMs. So there's 5 of us covering the country. And we would then put that person in contact with the local BDM to discuss the inquiry. Or someone can give me a call on my mobile, which is 07464 202 157.
Brilliant. Well, thank you so much. That's it for this week, everyone. Thank you, Peter, for being such a fantastic guest.
Thanks, Sean.
And thank you for listening or watching. If you want any further information on Glenhawk, please check out the website. We'll also be repeating Peter's contact details in the links below. I definitely recommend following Peter on LinkedIn and getting more news and updates on social media from him. Please share and spread the word about the show. If you listen on Apple Podcasts, please hit us with a 5-star review. But more importantly, please stay well and take care.